Welcome to The Explainer. Today, we're jumping right into a fascinating journey to demystify something that literally drives everything around us, and that is the concept of risk. We're going to explore exactly how humans and massive organizations evaluate risk and chase after reward. We'll start way zoomed in at the micro level, looking deep inside the psychology of the human brain, and then we'll scale all the way up to the macro level of global corporate strategy. The goal here is to give you a really clear, structured look at how risk is calculated, managed, and ultimately optimized.
Okay, let's dive into this with a pretty simple scenario. Imagine I come up to you and offer a bet. Would you pay me $50 for a 50% chance to win $100? Now, mathematically speaking, the expected value of this bet is exactly $50. So a perfectly rational, emotionally neutral robot would play every time. But in reality, most of us hesitate. The vast majority of people are risk-averse, meaning we're really only willing to gamble if the cost is less than the expected value. So why do our brains hit the brakes on a perfectly logical mathematical bet? Well, it all comes down to our innate psychological programming.
Here is our roadmap for today. First, the psychology of risk. Second, tactical trading in risk. Third, building the efficient frontier. And finally, strategic corporate risk management. Let's get right into it.
Section 1. The psychology of risk, inside the human mind.
Here's the fundamental truth of behavioral finance. Homo sapiens are just not perfectly rational economic agents. We have emotions, and honestly, our decision-making is deeply flawed by design. Nobel Prize winner Daniel Kahneman came up with a brilliant framework for this. He divided our minds into two distinct systems. System 1 is our default. It's intuitive, it's fast, and it's highly emotional. It's the system that makes you just grab a candy bar at the checkout aisle without even thinking. System 2, on the other hand, is deliberate, slow, effortful, and analytical. You're using System 2 when you stand there calculating the unit price of that candy bar to see if it's actually a good deal. Now, because System 1 is our default, it ends up making most of our decisions. And while that's an amazing tool for basic survival, System 1 is incredibly prone to systematic cognitive errors, especially when we're dealing with complex financial environments.
Now, what's really interesting about this slide is how these System 1 shortcuts turn into really dangerous cognitive biases in our finances. Take a second and see if you can self-diagnose your own blind spots here. First up, the disposition effect. That's our tendency to stubbornly hold on to losing assets while selling our winning ones way too early. Then we've got the herding effect, which is basically imitating what everyone else is doing, and that's exactly what creates massive market bubbles. And then there's the gambler's fallacy. This is the totally false belief that past events somehow alter future probabilities. It's like flipping a coin heads 5 times in a row and thinking, oh, tails is totally due on the 6th flip. No way. The probability is exactly the same, but System 1 tricks our brains into feeling otherwise.
But out of all of these, perhaps the most powerful rule governing our decisions is loss aversion. Get this, we are literally twice as sensitive to losses as we are to equivalent gains. Our valuation of loss is convex. The psychological sting of losing $1,000 is so much more intense than the fleeting pleasure of winning $1,000. And this built-in aversion naturally pushes us into totally irrational, fear-based risk-taking behaviors, like, for instance, refusing to close out a terrible trade simply because we want to avoid feeling that psychological pain of realizing the loss.
Which brings us to Section 2, Tactical Trading and Risk Mitigating Human Error.
So you might be wondering, how do the professionals survive in a market when their own brains are hardwired to make mistakes? The answer is strict mechanical rules. They use them to protect themselves from their own flawed System 1 impulses. And it all starts with one foundational number, 1%. This is the 1% rule, and it is the ultimate survival metric for intraday trading. It basically mandates that a professional trader never, ever risks more than 1% of their total capital on a single trade. So if you've got $500,000 in the bank, your absolute maximum risk per trade is $5,000. The math here is pure survival. Even if you hit an unbelievably unlucky streak of 10 consecutive losses, you only deplete 10% of your capital. You still have 90% left in the tank, so you can stay in the game.
And this brilliantly illustrates the real math behind long-term profitability. Having a positive risk-reward ratio isn't just a preference, it's a mathematical requirement. Look at the 1-to-3 ratio on the chart. If you risk $1 to potentially make $3, your break-even win rate drops down to just 25%. Think about what that means. A trader using a robust 1-to-3 risk-reward ratio can literally be wrong on 75% of their trades and still not lose money over the long haul. Properly managing risk is the only thing that makes that possible.
But to actually enforce these ratios, traders have to rely on a super strict mechanical setup.
First, determine the entry. Next, set the stop loss, which is a preset exit instruction that limits your downside. And finally, set the target. Modern traders use automated bracket orders to punch all three of these variables into the system at the exact same time, before the trade even goes live. This pre-commitment is absolutely crucial because it entirely removes that emotional mid-trade bias from the equation. So when the market suddenly swings against them, they don't have to sit there fighting loss aversion in the heat of the moment. The automated system just flawlessly executes the stop loss for them.
Moving right along to Section 3, Building the Efficient Frontier, Portfolio Optimization.
All right, let's zoom out again. We're moving from the nuts and bolts of a single trade to the complex math of managing a massive collection of assets. This is the realm of modern portfolio theory. When you take every possible combination of risky assets and plot them on a chart measuring risk versus expected return, the upper boundary of that entire space forms a distinct hyperbola. This curve is known as the efficient frontier. It is essentially the ultimate sweet spot for investors. It represents the specific set of portfolios that give you the absolute highest possible expected return for whatever level of risk you are taking. Anything that sits below this line, it's simply suboptimal. Harry Markowitz first mapped this whole framework out back in 1952, and it highlights a couple of very specific strategic portfolios. First, you have the minimum variance portfolio. This sits at the very beginning of the frontier, and it represents the absolute lowest possible risk you can take while still remaining efficient. Then, you have the tangency portfolio. If you introduce a risk-free asset into your mix, you can draw a straight line that perfectly touches or is tangent to the efficient frontier. That exact point of tangency is mathematically considered the optimal market portfolio. It basically gives you a highly structured mathematical edge against unpredictable market volatility.
Okay, Section 4, Strategic Corporate Risk Management at the Enterprise Level.
Let's move to and see how this builds into our final conceptual zoom out. This is the ultimate boardroom puzzle. Think of a hiker scaling a rocky, snow-capped peak. That imagery perfectly captures the strategic pursuit of risk at the massive enterprise level. Because let's be real, a corporation's goal isn't to just sit safely at the bottom of the mountain. You simply cannot create value without taking on risk. The real goal is to strategically scale those peaks of risk and reward, constantly balancing the elements so you can reach the highest possible vantage point without tumbling down the side.
The Institute of Management Accountants hits the nail on the head here. They argue that the core job of a board of directors is to actively optimize the company's risk-return profile. Strategic risk management isn't just about playing defense, right? It isn't just avoiding danger. It's about aggressively calculating how massive macro risks interact with the unique risks of their specific industry. It's about deciding exactly which risks are actually worth taking to advance the company's core mission and create real value.
And to put it in perspective, the macro risks these boards are modeling are absolutely massive. The World Economic Forum actually identified these 5 top worldwide risks based on their potential global impact. We are talking about the failure of climate change mitigation, the threat of weapons of mass destruction, global water crises, large-scale involuntary migration, and severe energy price shocks. Modern corporations literally have to model these incredibly complex, massively disruptive events every single day, actively monitoring them just to adjust their own strategic trajectory.
So from the automated stop loss of a single day trader all the way up to the efficient frontier of a portfolio manager, right into a boardroom navigating global climate crises, risk truly is the universal currency of reward. We absolutely can't eliminate it. But as we've seen throughout this explainer, we can systematically manage it. So I want to leave you with this final provocative thought. Knowing just how flawed human psychology is, how will you adjust your own System 1 impulses the next time you face a major financial risk? Remember, the very first step to mastering your financial destiny is mastering your own mind. Thank you so much for joining me on The Explainer, and keep learning.